Welcome. My name is James Barber. I'm your Oregon Cash Flow Pro. We're updating today on a number of positions that we're holding synthetic shares, meaning leap options, that we've been selling covered calls against. We've sold out of one position, and I want to share how we currently intend to play earnings. Now, these things can change, but I'm going to give you the thought behind where I'm at right now. We're still a couple of weeks away from earnings on Nvidia, and there could be some wild price action that happens between now and then. So let's take a look at where we're at right now. And remember, if you have any questions about why I'm doing something, especially if you have suggestions on ways that you think it might be done better, put them in the comment section below. I'd love to hear from you. So here we're looking at our current positions and trades on Nvidia. Before I go over this one, let's hop over to the one that I got out of earlier today, and that's AI. Well, I didn't get out of it earlier today. I got out of it earlier this week. Our position, we started by selling a long call. We sold some calls against it, bought them back, made some decent profit. Last week, you can see that we ended up rolling to the 36 strike, expiring on February 14th. Between that roll and the next day, this was Monday, the stock price shot up. This one has earnings on February 26th. That's the expected earnings date. Stock price shot up. There's a good chance the stock price could continue to climb. What I had sold for 37 jumped up to 93. And if I was going to roll it out, there wasn't enough premium to be able to roll it up in strike price. And rolling it straight out, if this continued to climb, rolling it straight out would barely earn me any premium. Now, my original position, I was up quite a bit. And I kind of got the feeling that it could basically go either way. And earnings either way. Plus, in addition to everything that we're seeing here, the challenge with being able to keep the strike price up with where the share price is and get decent premium, the challenge there, along with earnings coming up, I decided to just exit the position. And when we exited the position, we ended up with a total profit of $329 over the course of 2 weeks. That was a 2-week trade, risking $1,555. which gave us a 450% annualized return. It was a 21% return on this entire thing over the course of 2 weeks. That's not too bad. I'm actually pretty happy with that. It was a good result. There was nothing to complain about. As it turns out, right after I sold, the share price came down. As of today, the share price is down to $32.50. And the option that I had bought, that was 700 days till expiration that we were trading on, dropped in value. We've got a midpoint of about $15.50. I sold it for $18.80 just a couple of days ago, 2 days ago. So that ended up being a pretty good move. Overall, I'm happy with that. Now, something to keep in mind. That was generally just timing of the market. That's not going to happen very often. And ultimately, selling the covered calls repeatedly week after week is what we do instead of trying to time the market. Now, every once in a while, we end up in a position where we end up getting to do both. We sell the covered calls for a while until we're able to exit the position for a nice gain on the underlying, even if our original plan may have been to hold it until close to expiration. Sometimes you might just have somewhere else you want to deploy those funds, or there's just some uncertainty going on. Now, in the market right now, there's a lot of uncertainty. It's very volatile. I do expect that there's going to be some significant pullbacks at some point this year, and I would rather be sitting on more cash so I could deploy it at that time. So I was pretty happy to take the win on this, and let's move on to one of our other ones, GME. We just made a move today. We sat out for a little while from the 7th to the 10th, giving GME a chance to come back up. It finally popped back up. We ended up selling the 28 strike price for $35. We did that kind of in the middle of the day, and it kept going up. And had I waited just a bit longer, we could have ended up getting closer to $60 for that particular strike price. Fast forward to today. There was a dip in the market earlier today. I was able to buy this back. And so we bought it back for $16. Yesterday, I was negative on this trade, looking to see, will I get a chance to buy it back or roll it up? Because looking at the chart here on GME, this was where it jumped up. And it looked like it could continue to go up. And when it comes to GME, you just never know. Sometimes it'll just shoot up. I got the opportunity to buy that back. We made a little bit of profit. And right now I'm sitting uncovered again. Now, it's dropping because CPI came out and the whole market's been kind of impacted today, but this may end up turning around and bouncing back up. So this is the daily chart that we're looking at here. As far as the trends, you can see this was our first time popping back over that mid-Bollinger Band. Now it reverted back underneath of it, so that could be a potential rejection off of basically this area, which has quite a bit of transactions. So it's entirely possible that it just continues to go back down again for a little bit, but we're going to take our chances that this will turn back around and come back up. And if it doesn't, we can continue to wait. We're taking this one day by day. We don't have any earnings coming up, so not much to worry about. Back to the chart. Quick update on BROS. BROS, we're sitting in a long put position. Have a sold put out here to help offset the cost, buy us some time. Now this one's a 2-year expiration date. BROS had been trading quite high lately, but earnings is tonight. Earnings is tonight. We don't know what's going to happen. It could really go either way, and I'm not going to be too concerned about it. I was planning on being in this for quite a while anyways, and we're just going to sell some monthly puts in the meantime. So this one I feel a bit different about. This one is a lot less volatile than the other ones, and I'm basically okay waiting this one out for quite a bit longer. Just a gut feeling. Really nothing more than that, so take that for what it's worth. Let's check out Nvidia now. Nvidia, earnings is coming up on the 26th. We've got 2 weeks. Nvidia shot back up last week, end of last week. We ended up having to buy out and roll up to a higher strike price. And then, we mentioned this in the last video, Nvidia could continue to keep going up. And it did. It shot up to 134 or 135. So we're in a situation right now that looks like this. Nvidia pulled back today, back to the 131, which is right near our strike price, which is great. It expires in 2 days. You can see right now, it's about 245. Where it's at right now, we can still roll it to the following week and make some money. If we roll it to the same strike price, we can make almost $200. We can roll it up $2 to $3 and still make a little bit of money. I haven't decided yet what I'm going to do with that. I'm hoping that it hangs out right around 131 until expiration. If I can unload that completely without having to roll it, I will probably do that. I will probably buy it back, and maybe we enter a position for the following week that's way higher. We're going to give ourselves a lot of room. Now, that doesn't quite get us. This is the February 21st expiration, 9 days from now. That doesn't quite get us to earnings. We still got 1 more week after that to go to earnings. So I plan on bumping this up. We're going to get whatever we can get out of it. Now, what are we going to do for earnings? There's 2 ways to play earnings. I haven't decided yet which way I'm going to do this, but I'm leaning very heavily towards a particular direction. The plan is we're going to have this strike price up as high as possible going into the next week. We're going to roll up. We're always going to get a credit because if the stock price ends up coming down, we're out money if we put money out to roll up. So we don't want to do that. So we're going to roll it up as high as we can, or we're going to buy back the other one for a profit, and we're going to sell another one that's a lot higher out of the money. So let's talk earnings. We're in a particular position right now that the original call that we sold is up quite a bit of money. If we were to close the position that we're in right now, we walk away with $6,174 in credit. When you consider the position we're in right now, we're at $5,111 that we're in on this trade. So we have about $1,000 that we've made on this trade if we exit it right now. However, we don't really want to exit this position yet. We just want to be able to play earnings effectively in case it goes down. I want to be able to protect the profits that I've made. How do we do that with earnings where it could potentially go up or it could really get hammered, which some companies have gotten really hammered on earnings these days? Here's what I'm planning to do. Without exiting this position, as of today, my plan is I will either just sell this or I'll roll to this one. If I were to roll to the 95 strike, that's $10 above the current one that I own. We get to recoup all of the money I spent on the original call and get a credit. And I'm already profitable from the calls that we've sold. So I lock in all of those gains. Now, the reason I would do this, roll it way, way out and way up, is because of delta. If the stock price drops, let's say it drops like a rock, another 17% day, for whatever reason, earnings could just be terrible. This is going to lose value at almost the same rate that this loses value. And then we can just buy this back. We make a profit off of this one. We're still holding this one wherever we were at, but we recoup a whole bunch of actual realized profits by buying this one back for a lot less. And then we can go back into the original plan and just keep selling covered calls against this one at each week's expiration. Now, I could just close it out. I could close it out, realize the full profits, and that would be fine. The reason I don't want to do that is because I'm using this one as an anchor in order to track everything that I'm doing with Nvidia. Now, you might not care about that in your particular trading plan, but it's kind of nice for me to be able to just track this. It makes it easy to have this anchor point that I'm tracking off of. It's kind of like when you own stocks. When you own stocks, the broker itself keeps track of your basis. It's really hard to keep track of options from a basis standpoint, especially over the long term, unless we have this anchor that I'm tracking. That's basically why I don't want to exit it. Now, let's say Nvidia doesn't drop. Let's say it shoots up. If I'm in this position and Nvidia shoots up, the difference between this and this is about $600. I'm essentially locking in a gain over the next 2 years of $400 with a risk of $600. On an annualized return, that's good. And I have all my money that I spent on the original call that I can go redeploy somewhere else. That seems to me like a better use of capital than trying to chase Nvidia with deep in the money calls where I risk getting exercised. So that's my reasoning for what I'm expecting to do for earnings. What do you think? Any flaws in that plan? Any suggestions on how to make that better? I think this ends up putting me in a good position regardless of what happens with earnings. Now, if I end up buying out of the current short position, I might give myself more room here because I might have more room to play with depending on where the stock is at actual earnings. My main goal is to just recoup everything that I have here if it shoots up and I exit the position. So if Nvidia shoots up prior to earnings, because that happens quite often, we get a climb up into earnings. And if I'm able to be uncovered during that climb up of that last week, we may be able to sell somewhere down here, in which case I recoup all of my money and we end up with maybe 1,000 or 2,000 or 2,500 in potential gains over the next 2 years. So I'm excited about what's to come. Are you excited? Be sure to hit that like button if you appreciate what we're doing here. Subscribe if you want to continue to follow along with this. It's the easiest way to do it. Ding that notification bell so you get notifications when we put out a new video. We got a number of things that we're tracking here that are exciting. Our $10,000 investment in QDTE that we borrowed from a life insurance policy to fund, and we're going to use the dividends to pay that back. That's kind of an exciting trade that we're doing. We're keeping track of this here. Good luck to you in the market with your trades, and we'll be back again soon. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.